Good afternoon, everyone, and welcome to another in the series of the Real Estate Connections. We are going to get started in just a few minutes, so we'll allow you time to grab a drink or a bite since we are at the lunch hour, and we'll be joining you in just a moment. Good afternoon, everyone. I see a number of you have joined us, and we'll probably have some others jumping in just a few minutes. So my name is Dave Sullivan. I'm a shareholder and Director of Business Development at Perkins & Company, the accounting firm. And we have been doing the Real Estate Connections now for 6 or 7 years, but we all know that we have a new normal, and a new normal means we're going to be doing video webinars, I think, for a bit longer. And we're going to continue this series. We certainly miss having our live events where we're all able to be together, but this is going to have to do in the absence of that. And certainly Perkins & Company hopes all of you are doing well amidst all the uncertainty that we're having. I guess the good news today is the rain came out for the first time, and I love that because it means I don't have to water my lawn, and the tomatoes are doing great. The rabbits and deer are taking advantage of the lettuce in the backyard. So hopefully most of you have some kind of a garden or are doing better in that regard. This is a continuation of the series that we've been doing for the Real Estate Connection, and we're doing them in a way that is shorter. So we're just doing 30-minute quick updates on business and timely issues that matter to the real estate community. And I think as I was thinking about this and the topic, the only thing perhaps more complicated than trying to solve COVID or figure out the human DNA is taxes. And that's where we are today. We're going to get an update on taxes, both local, county, statewide, and also perhaps a little bit on the federal side as well. And just for the order of business, you have a Q&A function down at the bottom of the screen. And if you have a question, please pose it, just write it in. And if we don't get to it, we will follow up with a thorough Q&A based on the questions. We have a lot of material to cover today, so we may not get to that. We're also recording this session, so keep that in mind. You can share that among your community, or certainly go back and look at the information as we have it. So without further ado, it gives me great pleasure to introduce Mr. Tim Kahlberg. Tim is one of the shareholders at Perkins and one of the leaders of our real estate niche. I think a lot in the community think of him as sort of the guru of real estate, and he's having a lot of fun preparing for today, and I know he's going to have a blast sharing all the tax updates with you. So without further ado, Mr. Tim Kahlberg.
Thanks so much, Dave, and welcome everyone. We appreciate you sharing your time with us today, because we know your time is important from wherever you're at, and hopefully with this approach to keeping people informed and keeping in touch with people, you'll appreciate the information that we're providing. Dave, I don't know if I'd be called what you shared about me. I was thinking more it would be like grandfather as opposed to guru.
Well, you don't get to be a guru unless you put your time in and had your years, but it hardly looks as if you've been in this business more than 10 or 15 years, Mr. Kahlberg.
You're too kind, Dave, too kind. For those of you in the audience, this is the information we're going to seek to cover today. Primary focus is going to be on the first 4 bullets in terms of kind of the landscape of Oregon state and local taxation. And time permitting, we're going to get into some recent IRS guidance. We were fortunate enough that the IRS waited until after the extended July 15th deadline for all of us tax geeks to essentially push out well over 1,000 pages of regulations in the last 2 to 3 weeks. And that's what they're on those last 3 little topics. So obviously we haven't had the opportunity to digest them completely, but there are some quick hit tidbits specific to the real estate industry that we'd like to keep you up to date on. And to the extent we have time today, we'll touch on some of that. And if we don't get to it, we will certainly be sure to touch on it in a future connection event.
Tim, why don't we just send everybody the 1,000 pages and they can have some good bedtime reading?
You know, people probably have time on their hands to be able to do that now, don't they, Dave?
They do, but I think that's why they count on you and your team at Perkins to digest and make sense of all of it, right?
True.
Yeah.
They probably don't have the patience. It takes a lot of persistence to get through regulations. So let's jump into kind of an update on the Oregon cat tax. Obviously, we've now gone through our second quarter estimate at the end of July. We haven't had any filings yet of this return, but we've had some payments. But there has been some updates. And then we're also going to touch on kind of the key issues as we see them for the real estate industry and what we're struggling with. So the most recent information, obviously, the legislature met and in June 2020 enacted this bill that you see. And it did a few things, but it didn't really do much of anything of substance to the cat tax. Recall that the cat tax is a tax on gross receipts of businesses, essentially. So for real estate, we're looking at, we're talking about our gross rental income, or for property management, it'd be your property management income, construction would be your top line construction billings, et cetera, et cetera. And that tax is 0.57% of gross receipts in excess of $1 million. If you're under $1 million, then you don't have to pay the tax. But once you hit $1,001,001, then you're paying the tax, albeit it would be only a couple $100 for the first 1 million, but after that, then it's 0.57% of every dollar thereafter. So the adjustments that they made in terms of this recent legislation, as you probably have read through the bullet points, are dealing with the subtraction for the cost inputs. And what they really clarified there is how do you do that when you have either unitary groups doing business inside and outside of Oregon, and how you do the apportionment of those cost inputs. So that's what was really addressed there. Nothing of significant change there. Foreign entities can be excluded. Unfortunately, the use of foreign entities here is international foreign, not out-of-state foreign. So it's only international entities you can, in the right circumstances, exclude from the unitary group. The one positive is they did eliminate the annual registration requirement. If you recall before, they were proposing that you had to re-register your business each year. That's gone in most circumstances, so that's good news. And then lastly, they had put in some pretty arduous penalties if you didn't comply with the rules around quarterly estimates and filing and payment of the tax. They backed off a little bit on that in this bill. And on top of that, because of all of the hardships that businesses are experiencing and have been since mid-March in terms of COVID and the coronavirus, as long as you're making a good faith effort to either pay estimates or can't pay them and can document why you can't pay them, they're going to waive penalties for you. Doesn't mean necessarily that the tax is going to go away come April of next year and the payment and the filing deadline. But if you just are struggling and can't be able to do it right now, hopefully the ODR is going to understand and be good to you.
Hey, Tim, can I jump in just for a second on that? Just to let folks know when you're talking about COVID and dealing with the consequences and what we do or don't know, Perkins put together a CARES team specifically focused on the latest and greatest and all the changes that keep coming at us. And so if you have specific questions, if you have applied, received the funds, unsure about the next steps and whatnot, feel free to reach out. If you're with Perkins, reach out to your partner, your client service manager, and let us know. And if we can help you, we will. But we're dedicated to making sure that our clients are taken care of and are dealing with the complexity of all this.
Thanks, Dave. That's good information to share. And we're happy to help you in any way we can. I mean, we're invested in the community and want to give back to the community. And as they continue to say, let's all get through this together. Yep. Here's turning back to the Oregon CAT, and having gone through the first 2 rounds of estimated payments, as I mentioned before, these are the challenges that we're dealing with and we're finding clients are asking us the most about as we're trying to weave our way through this new law, which really nobody knows how to apply. I mean, we've gotten some rules, administrative rules that were proposed, and they're now being finalized by ODR, but there's still a lot of unanswered questions, or a lot of interpretation, I guess, is a better way to put it, in terms of how you apply those rules. So how do you compute commercial activity? Well, in the real estate industry, it's really gross receipts and gross rental income of your building, whether it be commercial, residential, industrial, however. Generally speaking, you would think that's pretty straightforward. One common question around that is, what do you do with CAM reimbursements or recoverable expenses and getting rebated them back as part of the rent from your tenants? Can you exclude those so you can effectively reduce your commercial activity and therefore your overall CAT tax? It's hard to argue if you've been putting those and showing those and filing returns, as including those as gross receipts, that you could exclude those. And they would be then part of your gross receipts and your commercial activity that would be taxable for purposes of this tax. So it's kind of an art, but what they do say, and really the only guidance we have to that point is they say, they refer to whatever is defined as gross receipts for federal tax purposes. So if it's gross receipts for federal tax purposes, then it's gross receipts for purposes of this tax. So that's a discussion topic with your tax advisor, and something that you need to look at. I sure wouldn't necessarily go inconsistent in 2020 compared to how you filed for 2019. So if you haven't filed your 2019 return yet, perhaps that's something you might want to think about. Probably the other big issue that we struggle with is this whole concept of unitary group and unitary filings. You've heard of us talk about that before, and you've probably read stuff on that. The challenge here is that they've added their own real definition of unitary group, and it doesn't have to be the same type of entity. So a unitary group could be an individual along with an S corp along with a partnership, for instance. That the 3 of those could be determined to be a unitary group, depending upon facts and circumstances. The guidance that we do have is that they say they define a unitary group as persons with more than 50% common ownership. So that's one prong of the test. So if you don't have that, then you don't have to worry about these rules. The second prong is, and you have to have certain facts and circumstances that make those groups come together. For instance, centralized management. And in the real estate industry, it's not uncommon to have centralized management. So that kind of stings us right there. Other options are economies of scale and purchasing power, or common administrative functions. Well, it's not uncommon to have that in the real estate industry as well. So, or if you have functional integration and purchasing and power and that kind of stuff. It's not uncommon to have that either. So we're finding it kind of difficult to implement these or to get around these. And so what the nexus of this issue is say you've got 3 different partnerships that own a piece of property, rental property each, and each one of those is under the hurdle, the $1 million, but combined, if you had to pull them all together, you're over the hurdle, then you'd have an issue, because then you'd have to file and then you'd pay tax among all of them. And then once you do pay the tax, you do determine your unitary group and pay the tax. Then the other issue we're finding is, then how do you fairly allocate that tax across the members of that unitary group? And probably, in our opinion, the fairest thing, though there's probably other options, is to allocate it based upon each entity's contribution to that commercial activity, so proportionate to their gross receipts effectively. Cost inputs and labor costs, to be able to take some off the table for the rental real estate. As these rules are written, we really don't have any. So we don't see, unless you have direct W-2 wage labor costs in your rental activities, we don't see a way that you have any deductions against your gross receipts. And then on the brokerage side, this agency exclusion rule, what happens if you get, you're an independent broker and you're sharing with the house? You've got like an 80-20 split or a 90-10 split or whatever. Is that 10% going to get double taxed? And I think that's what this agency exclusion is meant to cover. It's meant to say, hey, no, even though maybe the company collected 100% and then remitted 10% or 5% or 20% back to the participating broker, that participating broker would then have those gross receipts. And the entity, the brokerage company, would only have the 90% or whatever it kept. So that's kind of what the agency exclusion is about and how it works. Another question we've had is it a recoverable expense in terms of CAMs, that kind of stuff? And the answer is yes, so long as your lease is written to apply and recover gross receipts taxes, because this is a gross receipts, it's not a net income tax. So generally speaking, it is not excludable. And then obviously big is these last couple items. PPP loan forgiveness. ODR has come out and said, no, that is not commercial activity for purposes of these rules. So we don't have to worry about that on that front. But if things continue and downstream we have issues like we did back in the Great Recession, and we start talking more about cancellation of debt income, debt forgiveness income, it's not real clear whether or not commercial activity might incorporate that. I'm concerned that it might, but there's no answer for sure. That's a challenging question, Dave, and challenging issues.
Yeah, Tim, do you think, based on what you've learned from clients and talking to them, that there is one anxiety that pops up more than another regarding CAT, particularly for the real estate industry?
Other than having to pay it?
Yeah.
I think struggling with the unitary group is probably the biggest one we have.
Okay.
And that's quite honestly the one that we struggle internally with a lot too, Dave.
Great. All right. Well, let's move on then to the local situation a bit more with the Metro SHS tax, which is the supporting housing services. And I know there's a lot of uncertainty in that regard, and there's a task force that's been put together to try to create some clarity, but it doesn't appear that it's terribly crystal clear, but I know that you've got some insights and things that you want to at least be able to share.
Yeah, Dave. I mean, the good news is we've got some insider information, because one of our firm personnel is actually on the working group that's made up of kind of public and private individuals trying to address various issues. Now that this has been passed, So we've got at least some good insight there as far as some of the issues that they're struggling with and trying to address and figure out. So there's still a lot of answers. Good news is this tax doesn't kick in till 2021, so we've got a little time. Bad news is this tax does kick in 2021 because it was passed in this past May election. What it is basically it's a personal and business income tax to fund homeless services. And as you can see, it's basically 1% of either taxable income on the individual side with certain exclusions, or it's 1% of net profits of businesses with gross receipts greater than $5 million. So if you're outside of either one of those, you're not going to have to worry about this tax. But if you are inside of those, you are going to have to deal with those. So here's some more information about it. I'm not going to cover every one of these bullet points in the interest of time, but I think the key points to highlight here are, what about if you live outside the metro area but work inside, or you're doing business both inside and outside? Well, they're going to come up with some sort of apportionment methodology. The question is what are they going to follow? Because what they've been talking about, this metro tax is going to be administered by the city of Portland. If people recall, back in like the mid 2000s, we had a Multnomah County individual income tax, the I-tax, for 3 years. That was also administered by the city of Portland. So they've got the infrastructure. So the question is are they going to kind of mirror and look like what the Multnomah County business income tax rules are or not? And part of the issue there is because, keep in mind, this is both an entity level and an individual level tax. You could get double taxation. That was never intended by Metro or anybody as they put this together. So what they're dealing with is how are they going to address this double taxation issue? And the thoughts are as well, you might have an owner compensation deduction limitation like we do for city county, or they might give the individual a tax credit for the tax paid at the entity level, or they might give an actual deduction. So you just don't pay tax on the same amount of income twice. So there's definitely more information to come on this. We'll keep our audience posted with updates as we get more clarity around this. But it's here to stay till at least I think it goes through 2030 and it can be renewed. Quickly on Multnomah County, there's not in the city of Portland, there's not a lot there other than a couple of things to highlight. The county quietly raised their rate. They were at 1.45% in 2019 and prior. Starting 2020, it is now 2%. And then if you recall, the city raised its rate back in 18 to 2.6%. It was at 2.2% prior to that. So now we're looking at a combined 4.6% rate if you're inside both the city and county jurisdictions. The other thing that the county did is they raised their compensation deduction to $127,000. Prior to that, it was at $108,000. So at least temporarily, it's mirrored with the city of Portland. But interestingly enough, as I was drilling into this a little deeper, and I could have made an oversight, but it looks like that $127,000 is not indexed for inflation, while the city owner's comp adjustment is indexed for inflation. So we may or may not be the same for 2020. The city hasn't updated anything yet. To the best of our knowledge that we can find, but they may. And then the other thing they did is, as most people recall, the gross receipts exemption was 50% or $50,000, excuse me. Multnomah County raised it to $100,000, so you don't have to pay or file if your gross receipts from all business operations is less than $100,000. But if you're over the $100,000 inside and outside, then you are subject to this.
Okay. Tim, we have about 5 minutes left, and just a reminder for everybody, I guess you're going to give a quick update there, but a reminder that this session is being recorded And also we will follow up if there are any questions. We haven't received any yet, which must mean that you are doing a stellar and scintillating job, Mr. Colbert. But feel free, if you do have questions, pose them, and we likely won't have time to answer them, but we will follow up within the week with any answers to the questions you pose.
Thanks, Dave. And thanks for the time check. I think we'll definitely get through this slide, and we may have a quick hit on the regs update, the federal update. A couple of comments here. We've had some recent questions. The Metro Get Moving 2020 future local taxes on the horizon. As you know, the Metro recently, and as recently as July 16th, voted to put this measure on the November ballot. So you'll be voting on this come this November. And essentially what it is it's a transportation and infrastructure funding mechanism. And what it is a it's kind of like the TriMet tax is a way that one of my partners shared with me in terms of this tax to think about it. It's a payroll tax paid by employers who, on all of their W-2 compensation effectively, that's paid inside the metro area. And there's no low number or zero number, so it kicks in. And it can be up to a maximum of 0.75%. So that's 0.0075 of a dollar of payroll. And there's a couple of exceptions to that. If you're an employer who has 25 or less employees, you're accepted. Or if you're a state or local government, you're accepted. Otherwise, if you're outside of those two, and this does pass in November, then you'd be paying this tax. And if they do start at a lower rate, they have the ability to crank it up as they see fit, but they can't go above that 0.75%. And then quickly on the Oregon real estate transfer tax, the only reason that bullet there is I've read some things, and probably the audience has too, about the Oregon leadership down in Salem kicking around the concept of and looking at the funding mechanisms available of perhaps putting a referendum to the ballot for people to vote on. If you recall, right now we have a constitutional prohibition in Oregon for any real estate transfer taxes other than Washington County. But they're kicking around the idea of perhaps voting to remove that referral from Washington County. So, or from the state constitution, which if they did, then they could move forward with a real estate transfer tax. So that's out there further, obviously, than the Metro Get Moving 2020, but something to keep in mind.
Okay, thank you, Tim. Hey, I'm not one to be as prompt and timely, but we've got about a minute left, minute and 15 seconds, Tim, before the end of our 30 minutes. So I don't know if you want to do a 30-second IRS update, but I want to let everybody know too that we're going to be following up with another webinar on August 20th from 12 to 12:30. So you would have already received that invitation, and please respond and RSVP to that. We'll resend it again along with a recording and a PDF of today's presentation. So Tim, I don't know if you want to cover anything for 30 seconds before we say goodbye.
Sure. Good. As you can see on this slide, these were the areas we wanted to hit quickly. The 1031 regulations, which we had no guidance, they basically now define real property for purposes of this. And then there's a personal property safe harbor that's in conjunction with that. And we can dive more into that later. The business interest expense is the prohibition on being able to deduct 100% of your interest expense. Unfortunately, the tax shelter rules did not go away. So that's probably a key point for the real estate industry. And we'll talk more about that in the future. And then lastly, probably the biggest news of all of these is on the carried interest, that they came out in their initial guidance that we've just got last Friday, and gain on the sale of real property looks like can be excluded from that. So that's good news for the real estate industry. And we'll talk more about that in the future.
All right, great. I did get a follow-up question here regarding double taxation on the CAT, safeguards against that. But in the interest of time, Michael, we will go ahead and answer that, or somebody will take that offline with you directly. We'll also answer that question for the group, so we want to be respectful of time. We thank everybody for joining us. We hope you picked up a nugget or two. And Tim Kahlberg, thank you so much for being a part of the presentation. And there was a ton of information to digest. And we'll also do some more follow-up, a little deeper dive on some of the other taxation issues when we represent August 20th, the next webinar we'll be doing for the Real Estate Connection. So have a wonderful day, everybody. Thank you so much for joining us. Bye-bye.
Bye. Thanks.